My name is Anat Mati. I'm the director of the Corporation Society Initiative, CASI, which is a business school initiative powered by some faculty, some staff, and especially student leaders. Today, we're hosting Katherine Blunt. It's not her first visit here to CASI. CASI was created in 2018, and Katherine was here in 2022, in the fall of 2022, when we had a sort of mini conference with two longer sessions, and like 8, 10 participants total, that was specifically on corporations and climate risk in the real world, focusing on PG&E. PG&E is the local utility and was very much in the news around here for, causing fires and bankruptcy and all kinds of things like that, which Katherine wrote about. I have my book here too.
Oh,
In her book, which we were handing out in that event that had just come out, called California Burning: The Fall of Pacific Gas and Electric and What It Means for American Power Grid. So it was about energy, the power grid, and the particular case of this investor-owned utility, PG&E, that was the center of this area's attention. And at the time, she was on a panel called The Terrible Decade, which was describing essentially the teens years of PG&E, 2010 to 2020, 21. And then the next panel, and that panel had a fire victim that plays out in her book. CPUC, the California Utilities Commission, former, I like former, so if you speak more freely, commissioner. And we had another one in the other panel, which was about looking into the future, governing something like a PG&E, a utility that is a monopolist in an area and is, liable for all kinds of fire damage. And then the state comes in and the entire interface of rules and where the risk falls and all this stuff. So we decided, a few years have passed, that we should have Katherine back here. Because she stayed at the Wall Street Journal, where she was reporting and then writing this book till today. But we found out that she's actually moving from the beat on energy and utilities and green energy and things of that sort this week. So she's now for 2 days not on this beat anymore. I just found that out. Anyway, so Katherine is here, and she will be in conversation with Kate Cabot, who is one of our outgoing director students, and also one. Kate, thank you. And Kate is also a student in the sustainability school.
Yes. Yeah, joint degree. So I'm just going to spend the first half hour or so asking Katherine some questions, and then I'll open it up to the audience. So would love to have this be more of a dialogue. So in addition, when you guys have the floor, in addition to just asking questions, also sharing your thoughts or reflections on what you hear. So just to kind of set the stage, as we all know, wildfires have been increasing in intensity and scale over the past couple decades, with huge consequences both on landscapes and communities, but also on air quality and public health. Wildfires now burn nearly double the acreage every year that they did in the 1990s. All of us have probably been affected by it, either indirectly through air quality or potentially directly. We've heard the stories of all the devastation that fires have caused, evacuation, destroyed property, struggles to rebuild. And especially since the recent LA fires, I think more and more of us have heard these stories firsthand from friends, colleagues, or relatives. And this is probably not really going to change. There's probably going to be continuing more wildfires. It's going to continue to be happening at this big scale with more intensity as climate change continues and drought dries out forests and grasslands. And we're seeing this with other types of natural disasters as well, like hurricanes, floods. But wildfires differ from these a little bit because there's a much more human role in their cause. And so just to kick us off, could you talk a little bit about the human role in the increasing intensity of wildfires and specifically the role of utilities in that?
Sure. So in the utility context, utilities infrastructure it's not the number one cause of wildfires by any means. But when you have these high voltage lines, whether it be at lower voltage near homes and businesses or higher voltage kind of running through a forest to transmit power from the generating station to where it needs to be distributed, it's a lot of power. I mean, it's just like a lot of energy, and the consequences of infrastructure failure, as we've seen, have gotten a lot higher over the last couple of decades because, again, a lot of this stuff is in heavily forested areas, especially, we've seen here in California and elsewhere, cost of living is really high in urban areas, and you see people moving further and further out into these kind of what's known as the wildland urban interface. And so couple of things, right? So if you have a power line that fails in a forest, maybe 15 years ago, that fire would be relatively easy to contain, but we've seen periods of extremely severe drought, tens of millions of trees have died. So there's just an enormous amount of fuel, so that when that power line fails, the chances of it becoming catastrophic much higher than it might have been. And then layer on top of that, you have more people in the area and just more potential destruction of homes, properties, loss of life. And that certainly bore out for PG&E, and we've seen that elsewhere in Oregon, in Colorado, in Hawaii, and most recently in LA.
I think the other thing that would be helpful for our audience is just a basic overview of the utility structure, because you've done a lot of reporting on like the lack of maintenance and investment upkeep that has helped cause or like, for example, like the campfires because the central hook broke and then sparked a wildfire. So could you, could you explain a little bit of like how the utility structure works and how it's unique relative to other types of corporations?
So utilities are regulated monopolies. The idea is that it's a really capital intensive business. The idea is like, let's not build duplicative power lines or power plants because it's not, it doesn't really make sense for a business. And so, they're given the right to operate exclusively in certain territories if they submit to regulatory oversight. And the regulatory oversight in California is the California Public Utilities Commission. The PUC here and the PUCs elsewhere basically allow the utility company to make a regulated rate of return on investments that improve the overall value of the system. Because for a long time, utilities are really growth-oriented businesses, especially like after World War II, population boom. We went through a period over the last couple of decades in which power demand in the US was mostly flat. So you weren't really having to make the same sorts of investments to serve growing demand. I mean, it's not to say that investments aren't necessary. We're not to get too far afield of the question, but we're starting to turn the corner on that with electrification and AI related demand projections. But anyway, so that is to say that utilities and most electricity in the United States is delivered through investor-owned utilities. So they are beholden to shareholders and also the public and providing critical service. They make, 10%, 11%, 12% rate of return on an investment in building a new power line or upgrading a substation or something that you can easily quantify as being valuable, making the system more valuable. They are allowed to recoup the money that they spend on day-to-day operations and maintenance expenses, doing inspections, replacing tiny little pieces of hardware, something that's much harder to quantify in the overall value that provides, even though it is very valuable and very important, especially in the context of safety. So when you think about the 2018 Camp Fire, which destroyed the town of Paradise and killed 84 people in 2018, the cause was extraordinarily simple. It was a hook that was about this big, holding up a high voltage transmission line in the middle of the forest in a very remote area. It was original infrastructure from 1915-ish. It cost 50 cents back in the day. And it broke, it had just been hanging there for 100 years, wearing down little by little with every windstorm until it broke. And the reason why that happened is because PG&E was not doing adequate inspections of its system in that area, in part for a lot of reasons, because that area is really remote It's actually pretty hard to send people up there to like get a close look at this sort of stuff. I mean, that's where sort of the expense comes in, is the labor expense of getting people up there, not so much the expense of actually replacing it. But it was, when you think about how utilities make money, how they sort of optimize themselves on Wall Street, is traditionally it's been trying to minimize operations and maintenance costs to free up money to invest as capital. And that's part of the problem that PG&E faced. And this is not just a PG&E problem. Every utility sort of has this mindset. And sometimes it's a legitimate question to ask, where can you sort of trim the O&M budget? Where's the sort of the superfluous money being spent? But if you cut too close to the bone, that's very problematic.
Yeah. That, thinking about the context that we're in right now, where there's just been decades of kind of neglect of maintenance and upkeep, but increasing risks for utilities everywhere, not just in California. Do you think that the traditional utility model is still viable? Like, are there changes that need to be made or perhaps being explored in different geographies across the country?
Yeah, I mean, there's really no perfect model or perfect answer to the question. The alternatives to the IOU model in the United States is either basically a municipal utility like you see in Sacramento, or a cooperative, which is owned by customers. Generally speaking, you see them more in rural areas where you don't have the same population density that would be attractive to an investor-owned utility. In California and elsewhere, you're seeing the big question for utilities is liability costs. Liability stemming from utility-caused wildfires and billions and billions and billions of dollars. And so it's like, either technically speaking, under the IOU model, it's like that those costs are technically supposed to be borne by shareholders. But with PG&E, we saw a bankruptcy result from that, in which fire victims ended up very much being further victimized by that process. But then if it's, in a municipal model or a co-op model, it's okay, so the liability costs then either fall on taxpayers or the owners of the utility customers that are the owners of the business. I think theoretically, I'm not sure what the answer is. From a practical standpoint, I think it's very difficult, like a very expensive litigious process to rescue shareholders and trying to really change any utility that's already operating as an IOU. But I do think there's an interesting question, and I don't have the answer, which is how do you value operations and maintenance in the context of it's like an avoided liability, right? That's a really difficult question. I don't have the answer, but I think something that could explore that and incentivize that type of work that's necessary to make sure that failure doesn't happen, the company doesn't incur billions of dollars of liability costs. I think it's a really important and challenging question to ask.
Excuse me, Katherine, can you speak up a little? There's a 40-strong audience on Zoom right now that is having a difficult.
Yeah, I'll try to.
Yeah, we should have brought, but we should speak up.
Yeah.
Anyone already have questions?
I have
Maybe not quite yet.
Yeah, in a few more minutes, yeah. So one way that PG&E is trying to minimize their liability is actually through capital investment, through undergrounding.
Mm-hmm.
Could you talk a little bit about that initiative, and given the billions of dollars in costs that it entails, like what the future of it looks like?
Yeah, definitely. So PG&E, as of 2021, is under new leadership. This woman named Patty Poppy. She came from Michigan. What?
Alum of the school.
Oh yeah. That's right. Okay, so she came over from Michigan from Consumers Energy in 2021. 6 months into her job, a PG&E power line failed pretty close to Paradise in the same county. So ignited the Dixie Fire, second largest fire in California history, I think. Anyway, it burned close to 1 million acres. No one died, but it was destructive. It would just anyway. So goes up there and looks around and made this executive decision on that very day that she went up there to say, she's surprised the board of directors even, this hadn't even really been a conversation that they've had in earnest. She says the company's going to bury 10,000 miles of power lines.
How many miles?
10,000. We took this up in the conference.
Wait,
We had an expert.
what percentage of their?
Yeah, it's a good question. It's not a huge percentage.
I was going to say,
It's not a
But
huge
still,
percentage.
it was 10,000, which she just named.
but it's less than 10%, I think. isn't
I
it?
think it is less than 10%. I don't think much less than 10%, but it's
but it makes it sound more symbolic than 10,000.
And even 10,000 miles is huge
They're expensive.
and not always feasible, we heard.
Right, so the idea being, of course, if the power line is underground, it's basically, there's almost no chance of it causing a fire. Most utility caused wildfires happen when like trees fall on lines near homes and businesses. We've seen higher voltage transmission failure. Campfire is the primary example of that. That's not the type of line that would be targeted for undergrounding. You can't really bury transmission at this point. You'd be talking about lower voltage power lines, again, in the neighborhood, more or less. It costs like $3 million a mile to do this. They're trying to drive down costs by various things, but it's really expensive. And they say like, you know, we can do it for $2 million a mile. Well, that's in paradise where everything has been burned down. But you think about like permitting and digging and like all that it entails of getting the lines underground. It's a super labor intensive, cost intensive process. It would be a capital investment on the part of the company. They would earn a return on that because it's like changing the very nature of the system. It's a new sort of asset that they'd be building, so to speak. But this has been it's been a strong point of contention within the PUC because electricity costs in California are very high. And so you've seen a growing amount of rate pressure on the part of regulators over the last number of years. And basically the question, the last time the company sought permission to increase rates largely to start on this undergrounding plan. The question was, can you achieve similar risk reduction for less money? And so you have people who are advocating on the part of utility customers saying, why don't you just insulate the wires and make it so that if a tree falls on the wire, the likelihood of it starting fire is less. It's not zero, but they're saying by doing that and then investing in other technologies, you can achieve similar risk reduction at a lower cost. PUC ended up landing somewhere in the middle, authorizing PG&E to do some undergrounding, but also sort of expecting that they would try to do this other approach to risk mitigation as well. We'll see where that shakes out, but yeah, and then layer on top of that, the investments that the company is going to need to make to meet whatever ends up happening with AI powered demand, plus the state's electrification targets, the deployment of more electric vehicles. It's like we're heading into a future in which electricity is just necessarily going to cost more, but that doesn't make it easier for consumers to stomach, especially those of more limited means.
Does PG&E get rate increases? Have they applied for rate increases to cover this cost?
Yes, yes. Not as much as they were seeking, but yes.
Pardon?
Not as much as they were seeking, not as much as they were hoping to raise rates, but yes, rates have gone up significantly over the last 10 years.
And some of those increases actually go to cover like the cost of PG&E's lobbying and kind of consumer communications and advertising, often advertising and undergrounding to try and rehabilitate their image
Yeah.
in the wake of the fires. Yeah.
When you think about that, I mean, like that amount of money is like very small relative to like what they spend on the system itself, but that's been a point of contention.
Like, there are states like Maine that forbade a monopoly utility from spending money on lobbying and on advertising.
Well, they
Because
do
should-
something.
They should deal with the regulator directly. They shouldn't start doing the PR to get these capital investments on which they can increase their NPV. I'm a finance professor, you know, a bigger scale, same IRR, you know.
I was taken aback in the TV ad. They start the ad by saying,
Yeah.
this ad is not paid for by ratepayers.
What does that even mean?
How can they say that?
Yeah, I see there's some questions, so we can open it up.
I was wondering if you could speak to, do you think that, you know, shareholders having a capped return, but bearing all the downside risk will start driving capital allocated towards the sector away from equity and towards debt? So like in jurisdictions where they're doing municipal bonds to, you
Yeah.
know, the capital investment for
You're
all
already
this stuff
seeing
you're
that.
talking
You're
about.
already seeing that.
It's already happening.
There's been, I mean, it's been, utilities in the West have been a very hard sell for, especially, I don't know who, you guys probably caught this. I think it was like last year, Warren Buffett's shareholder letter was like, utilities in the West might not be a good investment. There was some, like, not to get too in the weeds, but Basically Pacific Core in Oregon was implicated in a series of fires over Labor Day in 2020. And companies basically faced a huge amount of costs related to uneconomic damages tied to those fires. The plaintiff's bar has gotten pretty sophisticated on this over the years. And he was basically like, we can't face uncapped uneconomic damage costs. The company at the time was lobbying, his Berkshire Hathaway, which owns Pacific Core, is lobbying at different state legislatures for caps on this, succeeded in Utah. But anyway, sorry. So Edison, Southern California Edison, serving outside of LA, is most likely going to be found liable for the Eaton fire, which destroyed Altadena. And you saw not only Edison's share price fall on that, but PG&E's share price as well. I mean, lost like 30% of market cap, just because one of the solutions implemented after PG&E's bankruptcy was to establish a fund, a wildfire fund within California that is meant to help utilities manage liability costs when their power lines inevitably start fires. And then there's this concern on Wall Street that, okay, if Edison takes a bunch of money out of the fund, what's left for PG&E when that inevitably happens? And there's like a huge question of like how to deal with this. And, you know, there's this idea that wildfire liability cost falls on shareholders, not customers. But PG&E's bankruptcy was like such a disaster. And again, like it was like the losers in the situation were the fire victims. Hedge funds made a lot of money on that. And it's like, it's a very strong case for keeping utilities out of bankruptcy. These are critical service providers. And like the distressed investors are going to come in and take all the money. And like, it's just a totally untenable situation. So it's super complicated, but like, yeah, it's been really hard for utilities in the West, especially that are most exposed to like retain investor confidence at this point.
Appetite in California for moving away from the investor-owned model, you know?
It's been floated, but it's really difficult to come up with an alternative.
So you're kind of raising the question of accountability and like these uncapped liabilities. I think the PG&E bankruptcy case, the most recent one, is super relevant for that. So you touched on it a little bit, but could you just take a few minutes to kind of walk everyone through what happened there?
Yeah, so PG&E started a bunch of fires in 2017 as well, like almost 20 in the wine country area. And so a combination of the 2017 fires and the Camp Fire in 2018, PG&E filed for bankruptcy in 2019 with an estimated $30 billion in liability costs. And in order to get out, it had to reach settlements with 3 classes of claimants. The first and the easiest class was governmental agencies that had incurred fire suppression costs. PG&E settled that for $1 billion in cash. They're done, they're set. But then the 2 more complicated classes of claimants was, so in California, utilities are strictly liable for all damages resulting from fires that they cause. And so that means that if I'm an insurance company and I paid a claim to a homeowner, I can go after the utility and say, you owe me that money. So the big class was subrogation claims, as it's called. So the insurance companies ostensibly, but a lot of the insurance companies didn't want to hold on to these claims. They sold them on the secondary market to hedge funds for like 50 cents on the dollar. So you have a lot of hedge funds buying for compensation from PG&E for these claims that they bought. They managed to negotiate an $11 billion all cash settlement, basically draining the company of cash, more or less. So when it came time to settle with fire victims and people who actually lost stuff, PG&E didn't have enough cash to fully compensate them in full. So it came up with a trust, $13.5 billion that was funded half with cash and half with shares in the company held through a trust. So now fire victims indirectly hold shares in the company that burned their houses down. It was like, I mean, just, right, I mean, and also the valuation of this settlement was predicated on the idea that shares would trade at like $14 and shares were trading at $6 for a couple of years after this was all wrapped up. So the trust last year, I think, finally sold its like last block of shares. At the outset, in emergence from bankruptcy, the trust held like 22% of the company, so it couldn't just dump it and compensate the victims with that money. Had to hold on to it for a while and strategically sell off, so that the process was really long and really arduous for victims. And the attorneys who were negotiating the settlement told all the victims that they would like be made whole, and of course they weren't. They're not going to see the full value of what they lost. And And then, yeah, PG&E somehow came out of bankruptcy with more debt than it went in with, and shareholders didn't take that much of a hit, and it was just like, the whole thing was like a mess. Like, I usually like, I sort of joke that like I try to keep my opinions out of this, but I don't think it's actually an opinion that it was a mess. I think it's just like a statement of
I have to
fact.
interject because my familiarity with this was COVID 2020. PG&E is about to emerge from bankruptcy. They go to court and plead guilty to 84 manslaughter charges. They pay like nothing for that. I mean, I had the CFO of the company, in my MBA class at some point, and it was like, and then, they filed for bankruptcy. So they were in bankruptcy and they had to get out of bankruptcy really fast. This was their second bankruptcy, by the way, in 20 years. And they were bailed out of the first one as well. So it was like, okay, what's going on? I'm teaching course during COVID, and I needed somebody to talk to it. And I thought that's an interesting bankruptcy to teach about bankruptcy. And I got talking to Will Abrams, who was on the same panel in 2022 in our event, a fire victim who also is in her. And he was telling me how bankruptcy works. Now I'm a finance professor. I always said, oh, bankruptcy, just you rearrange your debt and that's it. But now there were fire victims, and now, and then when he tells me how the process worked, I was just flabbergasted. And from a risk sharing perspective, I was completely flabbergasted that the insurance companies of all walk away with cash and the fire victims end up with undiversified stocks in a company that burned their house and they can't even sell them. So it's like, something's wrong. Something went very wrong. And the CFO would tell you, this he said in my class, I hope he doesn't come in. He wasn't the CFO, it was investor relations during the bankruptcy. The distressed hedge fund had control of the company during the bankruptcy, and all promised on TV that they won't dump the shares, except they did dump the shares, driving the price down once it was all over. And they, there were all kinds of issues around the lawyers and whatever else. But it was really one of those cases that told me that the way we're understanding bankruptcy, and you get this in the restructuring class and others, is too oversimplified in finance. That once you have non-debt liabilities such as tort victims, or other kinds of litigation victims, your bankruptcy is a weird place to settle some of these litigation risks.
And I guess as a follow-up to that, given the company has more debt now than it's ever had, their infrastructure is in a weaker space than it was 5 years ago, just simply based on the fact that it's aged. And the power demand is now continuing to go up with the increase in data centers that we have. What is the right model, or even a different model that we can use to fund that new infrastructure that we need? Because if they go back to Wall Street, their share price, as you mentioned, is $6. Let's say they do an equity follow-on, they're going to tank. They do more debt. They can't do more debt. They're maxed out. They're tapped out. How do we build the capacity we need?
I mean, I wish I knew. No. So PG&E has been in this space for the last few years, in which they've been trying to find they call it creative financing alternatives, right? So yes, I'm remiss to say this, I'm not exactly sure where the credit rating is right now. They did not emerge with an investment grade credit rating out of bankruptcy, which is just that just drives up borrowing costs, obviously, and we pay for that ultimately. But the share price has since recovered to an extent. It's been down since the Edison fires because of the wildfire fund issue. So it's not, and also, but the other thing too is it was sort of very trying not to raise equity for a while so as not to dilute the value of what the fire victims held. They're now out, so it can raise equity in a way that it wasn't doing before. But yeah, I mean, between the amount of debt, the credit rating, issues generally with raising equity, risk associated with that, they've just been doing things they struck some deal in which they're leasing space on their towers for telecom or something along those lines. They tried to spin off part of their generation portfolio and sell it to KKR. That didn't end up working out. And just these sorts of things in which it's just they're, I mean, I don't mean this flippantly because this is a very serious situation, but it's kind of like searching for money under the couch cushions. It's
There's not enough.
there's not much to do. And so that was a big headache it continues to be a headache for the CFO in terms of just what do we do? And it's a really tough question. I wish
Because the odd part about it, and we did that case in Mike Harmon's restructuring class this year, is the PG&E's infrastructure has to exist. If the company were to be turned off tomorrow, someone would go and operate it because
We need the lights.
we need the lights,
you
right?
can't,
So then the question is is there not a way to clear out the entire capital stack and say, look, this company, like, sure, if you're a hedge fund or a debt owner, you know, if you're in that capital stack today, you know this company is going under. No one is like unaware of that. And we need to start fresh because there is no more money, but we need the lights to be on.
I mean, that's nationalization, isn't it?
But I know it
But
sounds
I mean,
weird
they
to say,
actually
but
never went to zero the whole time.
yeah,
So it was stayed over water.
but they won't do it. Like California's, the government won't buy it.
It got, I mean, the idea was floated during the bankruptcy.
Yeah.
Never
But,
pursued
I
it.
mean, no, the state doesn't want to own it.
Doesn't want to manage it.
I mean, I mean, then all liabilities become a taxpayer issue. This is like extremely expensive to run. The whole notion is that, like with the IOU, is that you should have easier access to capital markets than, but like, I don't know. I mean, I don't know where, but anyway, it would just be hugely expensive. It's such a big utility, 70,000 square miles. And there's also like legitimate serious doubts as to whether the state of California could do a better job than PG&E, right? But what was I gonna say? There was like a clause in some agreement at some point that if they like failed to do something or other, they'd have to put themselves up for sale and invite someone else to come in and do it. But like, who wants to do that? I don't know, like, so, yeah, it's a super tough question.
Another alternative to, instead of trying to mitigate the fires, just get much better, like shutting them down when they start, like solving for managing wildfires.
Right.
Have they made any progress in these kind of solutions?
You mean proactively shutting off power? Yes, yes. So that's been
Outages, yeah.
that's been a big focus for PG&E and increasingly a lot of other utility companies. So this notion of proactively shutting off the power stemmed from San Diego Gas and Electric had a huge fire in 2007, known as the Witch Fire. A lot of firefighters died. It was really pretty scary, but they went to the PUC and sought permission essentially to, when the winds pick up and make it likely that a tree is going to fall on a power line, let's just shut it off ahead of time. People will go without power for a little while, but it'll be better than the alternative causing a fire. So San Diego Gas and Electric pioneered this. Southern California Edison eventually adopted that practice, and then PG&E never really did until 2018, like right before the Camp Fire, they had a tiny one. But then the next year, as they were in bankruptcy and like the cost of it could not risk starting any more fires, basically like shut off power to like 5 million people in Northern California for like sometimes for as long as 4 days. That was a really overreaching use of that strategy, but they've since gotten better at installing technology on the lines to make it more surgical so that you can shut off power to a smaller number of people. They've gotten better with the restoration response times, and they also have settings on the lines as well at this point that if something touches it, it just immediately shuts off. So this has been really significant in driving down ignitions year over year. Just the challenge with that is the reliability metrics are in the tank. And that's a big challenge for people who rely on electricity for medical reasons. And it's going to become more of a big deal as we rely on electricity more for like home heating and cooking. If you're going to go that route of electrification, opening the garage door if you need to evacuate, just stuff that's like, there's like a lot of contingency stuff that makes that challenging, even though it has been a big boon for safety.
Yeah, maybe a foolish question, but there be ways for PG&E to offload some of the risk, say in very highly developed areas, to some insurance company. They could insure themselves on fire risk. That incentivizes them to increase safety because then their premium will go down. And they could have that case. Was insurance ever tried by a corporation to protect its shareholders from that risk?
They do have insurance, but it's become a lot more costly to obtain. And similar to like the general insurance market in California that you're seeing, like fire has just been a big problem. I mean, premiums for utilities as it relates to like wildfire coverage, it's just so.
There was a question.
Yeah, I was curious if there are efforts to change rate making to allow utilities to like earn return on vegetation management or like incentivize O&M.
I wish I had there's a former PUC member who can speak really eloquently on like the very limited alternatives there are to the way that rate making is now, like kind of like performance-based regulation, which is tried in some other places. I'm not gonna try to embarrass myself by getting like super in the details about that, but I think the question of that, like, what is the value of vegetation management? What is the value of proper inspections? What's the value of proper maintenance? Because I mean, again, it's challenging because you're sort of like trying to prove a negative, right? That this is gonna avoid the huge costs that we might incur if we don't otherwise do it. But that's just, I think it's a question that regulators should be asking.
The thing is, they're interacting with other policies. So land management, controlled fires, California has been really bad about this because we've suppressed fires for so long. And, in some states, they've had controlled fires that cleared some areas and sort of prevented the explosive fires that you get when you suppress fires too long.
I have a question about the infrastructure for underground wires. So my dad was a lineman and worked for a power company for more than 40 years. So I kind of have an appreciation for how labor intensive it is and also how dangerous it is. But I'm curious if there are any incentives or even tax subsidies for land developers to do underground wiring as opposed to just traditional.
That's a great question. I'm not quite sure. You do see like a lot of developments in which the stuff is underground. I'm not sure what the incentive structure for that is, so it's a good question.
Staying on those lines. So is the mandate now that any new power lines that are installed all have to be underground?
You mean the state requirements?
Yeah.
No.
And I guess, could you talk through a little bit of like why that is, and also just, I don't really understand why when we were originally building out the grid, and why those ideas weren't explored then?
I think, well, when you think about when the grid was built out, I mean, really at the turn of the 20th century, I think in part, it's like building lines overhead, I guess. I mean, electricity was still sort of an experiment. And I think that like, when you put a line underground, it does make it harder to maintain because it's harder to access. You have to dig. Whereas if it's overhead, it's more easily accessible in most cases. But I don't have a perfect understanding of this, but what's sort of interesting is you see a lot more underground wires in Europe because after World War II, there was so much destruction. I think like in part, like there was sort of like a safety question or a security question in terms of rebuilding, and a lot more went underground in Europe than you saw in the US because we didn't have the same sort of rebuild opportunity. I mean, I guess post World War II, there was a lot of building that happened. But the question though really still is like, it's just the cost. It's like, it just costs a lot more to do it that way. And that's the thing that PG&E has been butting up against, and even wanting to do 10,000 miles of undergrounding, which is not the majority of the system by any means. But the PUC has been like, okay, like that's going to cost a ton of money, even if it brings the fire risk next to zero for these circuits. PG&E's argument is like, over the 40-year life of the asset, it's cheaper to do it this way because we're not spending millions of dollars keeping trees away from the lines and all that, which I kind of believe, having not done the math myself, but like the upfront cost of that is huge at a time when rates are already really high. So no, it's not a state requirement because the state's trying to grapple with like, okay, yeah, we're very interested in risk reduction, but we're also interested in trying to make keep California an affordable place to live. Not that it is, right? But yeah.
This might be a naive question, but when you look on other types of utilities, like telecommunication utilities, so underground wiring and even like sub-ocean wiring is much more common because these are newer technologies, and when they were first laid out, they were laid out this way. So it seems that it's not a question of whether we have the technology or the know-how of how to do it. That all exists. It's just that we have an existing alternative. So we have a default option to avoid these kind of capital investments. So theoretically, if those lines were outlawed or like there was a main shift in regulation, that would naturally move like electricity utilities to the same place as other utilities are at now. I'm just interested in how does this discussion looks like in like state and federal levels, and what are the counter arguments, except for this is very expensive, right? It's expensive, but it seems like we're verging on a point where the alternatives are already more expensive.
Yeah. I mean, there's a few other considerations. It's sort of like, there is like, it does change the approach to maintenance. It's not suitable in every area just because of the conditions of the ground, or like, there's also some questions about, I mean, I don't know why it would necessarily be a different, if we're talking about seismic risk, I don't really know whether it's why it would be different underground versus above ground. But yeah, I mean, there's like a lot of considerations as to like, does it make sense for this thing to go underground here? Given like where, I don't know, in terms of like at the federal level, there's been some money allocated for like grid modernization broadly as part of like, I think like the infrastructure bill largely. Maybe a little bit in the Inflation Reduction Act. But like, I don't think it's like specifically necessarily targeted at undergrounding. I don't know that that conversation is happening at the federal level in any major way, or at least any way that's been like made public. In it's certainly a conversation at the state level right now. And after like watching PG&E propose undergrounding, San Diego Gas and Electric started proposing more undergrounding. They've sort of butted up against the same tensions within the regulatory body about like, okay, like this, like, yeah, this upfront investment is too much to ask your ratepayers to pay right now, even if it benefits the ratepayer 40 years from now. So it's just been a tough question, but like, I agree with you. It's like, that's an interesting way to think about it.
Yeah, one quick follow-up question back on the capital structure. If you look at other countries, some of them like England with their trains, they go to the first group, I think it's a publicly traded company, and they say, look, someone else is gonna own the actual train car, someone else is gonna own the rails, and then you're gonna be the operating vendor. And you have a contract for, let's say, 5 years, and you have to operate it, and then it goes up to bid again. And if the delays are very bad, or the ticket prices are out of control, or the maintenance isn't very good, then it goes to another vendor. Virgin famously lost their renewal bid, I believe, to First in England for this. Has that ever happened in the US on power, where it's like someone else owns it, you effectively sell the infrastructure to someone else, and you say you're gonna operate it for 5 years?
Yes, and this is exceeding my knowledge a little bit, but I think Long Island Power Authority, I think, basically, I can't remember why that was established, but there was a contract with the New Jersey utility, I think, to operate that. And it was definitely some sort of performance issue. And I'm sorry, like, it's like piquing my brain when you ask the question, but I think that that's a place to look in terms of like that, but it's not been common.
Some questions over here.
Yeah, the grid is a very old model, centralized with distribution. If I had a clean slate, okay, distributed, distributed generation, less heavy.
Right.
Anyone looking at that?
Yeah, definitely.
That changes the financing, changes the risk, changes many things.
Yeah, no, and then there's a lot of people who really strongly advocate for like, what can we do to have like basically less long distance transmission, carrying the power from the power plant miles and miles and miles and miles through the forest just to distribute it to people who live really remotely. And then like PG&E and other companies are involved in like creating like microgrids in which like for example, the one that I know to be existing is the town of Calistoga in Napa County, can like more or less exist when the power around it goes down. And then there's sort of the idea of like, okay, if we can do a lot more with rooftop solar and batteries on homes, can we minimize the need for both transmission and distribution infrastructure? The answer to that is like, maybe, because you still need sort of like, you still do need grid connection. Like it's like very, very hard to exist truly as an island. So you do need some of that infrastructure, but then there's also like, if some of these crazy demand projections play out, it's really hard to like consider how we're not going to need just actually more of the same, or at least the way these companies are imagining it.
So, but yeah, I mean, distributed generation is definitely, or backup power in certain areas as like something that sort of can exist in and of itself is something that's being explored by a lot of different.
Being explored, but it's not in PG&E's interest to have that at all.
I wouldn't say at all.
Okay, well, tiny little bit. It's like,
To the extent you still need some infrastructure, it's stuff that they're gonna continue to be able to invest in and make a return on, and like, it's not really within their interest when like their customers are like extraordinarily mad that they're without power for 4 days. So it has been like investing in ways like again with Calistoga and other places with like this microgrid concept. And also like they don't necessarily want to be constantly having to like inspect and maintain these ancient transmission lines, right? It's costly. So I don't know. I wouldn't say it's totally against their interest, but utility companies are also stodgy, traditional, slow moving. Yeah.
Couldn't PG&E be given the monopoly rights to operate the distributed power? I mean, that would, sure they could, and then it'd be totally in their interest.
But I think in the
contract with Tesla to install a lot of batteries on their grid to just like sort of pilot that.
I know they've done it, like in Australia, they've done that and so on with
Hawaii is a lot
solar
smaller.
and so on.
Hawaii's doing it.
So you can do it at a smaller scale, like, I studied EE, 40 years ago. And, this was a known problem there. But, the structure of industry, how do you change that?
yeah,
I don't know.
question of our time. Yeah. I think the distributed generation like creates more pressure for utility economics as well. And so it actually makes it harder to fund some of the investments like undergrounding or other better maintenance as well, because if you think about who's installing rooftop solar and batteries, it's pretty wealthy people, especially now that like some of the net metering like incentive to do that has gone away. And so it actually like creates like it's pushing more cost towards the poorest ratepayers who are already struggling to afford their electric bill.
Yeah, are there any incentives or thought at maybe the local or state government level on how maybe more private sector actors could be brought in? Incentives, to solve, better insulation or better grounding techniques. Is there like a fund or any incentives for other nimbler private market participants to kind of help PG&E, try things out and solve that problem, basically?
PG&E incentivizes, and other utilities incentivize energy efficiency. Like there's like a lot, but in terms of like outside of the utility, in terms of incentives for them to work with or allow for types of companies that you're talking about, I'm not really sure the answer to that. I want to say yes, but like not to like a huge extent, but that's sort of getting outside of what exactly I'm familiar with. It's a good question. That's a question.
To what extent do you see this as like a California problem? Like HECO had a similar situation, but it seems like most of these cases have been in.
It's not just a California problem. So it was, it's been really acute in California for longer, just because of California in particular just went through some like periods of really bad drought, and like the way that the infrastructure is configured, and like just the really poor health of the forest and the consequences of utility caused fires. It became clear this is a problem, but like there's other places in the West in which this is like just as much of a problem. It's been a problem in Oregon, it's been a problem in Colorado, it's a problem in Hawaii. So now you see other utilities in the West trying to learn from what California did in terms of risk mitigation. Different utilities are at different stages of like preparing wildfire mitigation plans formally, communicating with regulators on like what's best, what is proper to adopt from the California model of risk mitigation versus like what is sort of maybe more tailored to the specific geography in which they are.
not every utility in the West at this point has protocols to proactively shut off the power. And like, that's really at this point considered best practice at this juncture, like before maybe other solutions might be able to come in to better preserve reliability. But it's like not just a safety question at this point, it's also a liability issue. So like if at this point in time, if a utility in the West, especially with like significant wildfire exposure, doesn't have a PSPS plan, like the lawyers are gonna go after that pretty hard. So it's a big scramble. It's a big scramble right now to try to figure out what to do about this.
Oh, sorry, wait, you haven't spoken.
I was just wondering, has this kind of type of bankruptcy problem occurred with other types of utilities, or is it kind of isolated to power utilities?
Oh, bankruptcy in the utility space generally is like really uncommon because I mean, it's PG&E. There's been like, I can't even really think off the top of my head of any other bankruptcies in the utility space. I mean, I'm not saying that there's been zero, but the most far and away, the most prominent ones was PG&E #1 and now PG&E #2. Because utilities are like all but guaranteed to make money, right? They're like allowed to recoup the vast majority of their costs through customers. And then also if there's a shareholder component to make a return for shareholders, it's like they're designed not to lose money. So to have like this overlay of wildfire liability, it just like it's very much a stress on that idea, clearly. And yeah, like even there's been talk of like the prospect of bankruptcy for some of the other utilities that have been dealing with fire-related liability costs, but so far it hasn't been the case.
If liability is the biggest problem,
Mhm.
why not bring in the competition new group without liability because they won't have the existing infrastructure, but they can restart building modern with less liability with safer protocols? Is it too capital intensive that no one really considered it, or is it actively being held off because PG&E wants to keep the monopoly in place?
Sorry, do you mind repeating the question?
Is it because PG&E just wants to stay as a monopoly and it's the only way they think they can survive and they're lobbying well enough that it stays the way it is? Or is it because no one wants to actually go into this?
I'm sorry, what do you think what are you proposing as the alternative?
Just, cap raise, I don't know how many hundreds of billions, but bring in someone else who'll start building a new grid. That'll be parallel to what PG&E.
That nobody wants to do that because that'll be duplicative for one, but then also like PG&E does want to keep it the way that it is, but like that was like sort of like goes against the sort of it does make sense as to why a utility would be a monopoly, right? Just because this is like super capital intensive and like build stuff side by side that's competing. We've really only seen that so far in the power generation space. So there's competition in a lot of places within like people competing to sell power output on price, but it's really hard to imagine what that model is for like the actual wires that distribute, right? So because it's a good question though.
Going back to technological innovation, we're seeing a lot of tech startups trying to solve this problem, a lot of the wildfire related problems nowadays, and there's a lot of interest from private investors as well to invest in these kind of tech solutions. And you mentioned earlier that utilities tend to be slower in adoption. Have you seen any shifts in the PG&E or other major utilities capacity to adopt new solutions or structural changes to meet this market supply that is now raising?
Yeah, definitely. I mean, PG&E has been trying to engage with startups and just general, technology and other potential solutions. And it's even sort of like, I don't want to say like incubate, but it's definitely been involved in trying to get some of these solutions off the ground. And they have like a whole like innovation day now every year in which they're trying to like better leverage AI and all kinds of stuff that could help them either have better situational awareness, wind speeds, weather. I mean, when you think about the amount of data that utility companies have, just the millions and millions and millions of images and documents and all that, and trying to better process it, trying to like engage more stuff that would be like more predictive maintenance or preventative maintenance, predictive. So rather than just like run to failure, like know when that's going to fail ahead of time and take proactive steps. So for sure, I can't like get a total readout on like how much that's been helping, but there's definitely an interest because they're just sort of like, we have to solve this somehow. And a lot of utility companies are trying to, just generally trying to engage on this. I think the world of AI, even before the conversation about generative AI, had the potential to really help with just general data management, which has been historically a big challenge for utility companies. So yeah, I mean, I wouldn't say that every utility is taking it as seriously as some others, but there's opportunity.
Yeah, so, oh, Rachel, I was just gonna say, we only have a couple of minutes left, so I was gonna ask if you had any reflections on like your last 7 years reporting on this or
Oh, yeah.
learnings, takeaways.
So as of like a couple of days ago, I'm gonna be covering Alphabet and Google. But yeah, I mean, I feel very passionately about the space, obviously, and it was just time for a new challenge. But I mean, there's never been a better time, a more critical time to write about energy and learn about energy, especially the power side. Power is extraordinarily complicated, and it's been a real motivating factor for me to try to help people understand this space. And I think that people are thinking about the grid in ways that they historically haven't had to, because power and power quality and safety has been sort of a given for a while, and it's really not anymore. So it's been a real privilege, and it's at times been a real challenge, and at times it's been really trying, just because at the end of the day, when you're talking about a utility related disaster, people die, they lose everything, and having to really sit with that is challenging. And it's even more challenging to think about the fact that there's no easy or perfect solution. It's going to take a really long time to fix this at a time when climate change continues and things continue to deteriorate. But yeah, it's if like this space is of interest to anybody from a business standpoint, I mean, there's really no better time to engage with it. It's really important.
I would sneak in one
Yeah.
question that might be in your two beats. In the fall 2022, we also had Nicole Perlroth here, who talks about cyber security. And she has been saying that, it's antiquated technology and that we face cybersecurity risk in our grid and our utilities. Is that something that you are aware of?
That was not a space that I dug into deeply, but we absolutely face cybersecurity risk. No,
Because like a
no question
national
about it.
security risk that you have a cyber attack on a utility. I mean, we had Colonial Pipeline. That Wright showed you, and it wasn't an act of war because they actually just attacked the payment system, but it shut off, it shut off a lot of the East Coast for a few days. No gas, no diesel. And it was a cybersecurity, a cyber attack.
Yeah, definitely. No, it's a space that my former colleague, Rebecca Smith, unfortunately, she passed away, but she covered utilities for us for many, many years and was really looking closely at this before she unfortunately passed. But her parting words were, "This is a huge problem." Like, yeah.
One more thing to worry about.
One more thing to worry about is if we needed any more. Yeah.
On that scary note, we're out of time. Thank you guys for coming.